and accustom yourself to the fact that the market could be up 20% in a month and then give back that 20% over a long weekend. The one thing I'm certain about for 26 is that we will experience breathtaking volatility. If you're prepared for that volatility, both psychologically and financially, you'll do fine. And it wouldn't surprise me if I got it. I'd like to greatly increase my position in Schlumberger. Schlumberger is on fire, which is not what you want if you're a buyer. It's what you want if you're a seller. So I'm praying for a little negative volatility in the oil price. I need to say something else, Andy. I bought, well, that's not true. I put in bids on 5 oil and gas juniors yesterday. Well, I'll tell you, I thought 25 was going to be a pretty good year. Boy, was I wrong. It was a spectacular year.
Right.
And I think part of the performance that I would have expected to enjoy in 26, I enjoyed in 25. Which is to say, I think for the next 10 years, that precious metals and natural resource markets will do well. But I think some of the performance that we would have expected in a normal year was already used up by an extraordinary year. I think we will see, for better or for worse, a lot of volatility. I know that the precipitous decline that we saw February 1st in silver unnerved a lot of folks. I've been in the silver market for 50 years, so it neither unnerved nor surprised me. But we'll see more of that. But I think your listeners need to come into 2026 understanding that the move that occurred in part of 2024 and 2025 was really reducing tension on a coiled spring. In other words, some of the move that we enjoyed in 2025 was a delayed move from prices that didn't move in 20, 21, 22, 23, 24. Okay. That latent energy has been used up. So don't look for 26 to repeat 25. Look for it to be a good year, but not a great year. Think of it in the context of what has to happen over 10 years. And accustom yourself to the fact that the market could be up 20% in a month and then give back that 20% over a long weekend. The one thing I'm certain about for 26 is that we will experience breathtaking volatility. If you're prepared for that volatility, both psychologically and financially, you'll do fine. Yeah. If you weren't, you'll be shaken out for no reason.
Yeah. About that, so you might have used the same saying, and I use it all the time, and our friend Doug Casey's used it. Volatility is your friend. Embrace volatility. It can be. It can be.
Experienced investors treat volatility as a tool, not a threat. When prices rise vertically, forming what traders call a parabolic chart, the prudent response is often to trim positions. Locking in gains during euphoric moments can protect capital before inevitable corrections. Likewise, steep sell-offs may present disciplined buying opportunities. This strategy requires emotional control. Instead of chasing headlines or panic selling, seasoned portfolio managers scale in and out methodically. The objective is not perfection, but risk management. Selling a portion after strong advances can recover initial capital, effectively reducing downside exposure while maintaining meaningful upside participation in long-term trends.
We, in October of 25, had a day that, had it occurred in commodities, would have been lock limit up. There was no ask in the junior equities markets. There were all bids. I've learned in my life that you do whatever the market makes really, truly easy. If there's no asks, you serve the market and throw up an ask. If there's no bid, you serve the market and throw up a bid. So I, like you, in late 2025, August to be specific, I sold 25% of my junior stock portfolio. I did it because by selling 25%, I recouped all the capital that I had invested in the sector and paid the capital gains tax on the sale. In other words, I sold off 25% of my upside, a quarter, and I eliminated my downside. That's a pretty good print. Now, I had what I guess was an unusually good collection of stocks because the remaining 75% has now attained the value that it was before the sale. Do I feel bad about the sale? because of the money left on the table? Not a bit.
Mm-hmm.
Not a bit. Volatility works both ways.
Right.
What you learn, if you've been in markets as long as I, is that when a stock chart goes parabolic, what the Canadians call a hockey stick chart, where it goes straight up, it's going to go straight down for a while after that. The backside of the stick is just as steep as the front side, but if you're long, it's a lot less fun. So from my viewpoint, whenever I see a parabolic upside, assuming that nothing else has changed, I sell. Mm-hmm. Similarly, when I see a day like we had not too long ago, where it's a parabolic downside, you might buy. I'd like, as an example right now, to increase fairly substantially my oil and gas portfolio. But the oil and gas stocks are trading up. They're trading up because of news in Iran. They're trading up because of Venezuela. They're trading up because of Trump's allegedly tougher Russian sanctions. And so I'd like the market to cool off. I'd like the oil quote, which is now priced up to, spiked up to 66. I'd like it back around 53, 54. And it wouldn't surprise me if I got it. I'd like to greatly increase my position in Schlumberger. Schlumberger is on fire, which is not what you want if you're a buyer. It's what you want if you're a seller. So I'm praying for a little negative volatility in the oil price.
Energy markets illustrate this discipline clearly. Oil prices recently surged amid geopolitical tensions involving Iran, Venezuela, and renewed sanctions rhetoric. Companies like ExxonMobil and Schlumberger have climbed sharply. Yet experienced investors often prefer to buy when sentiment is negative, not when optimism dominates. The most attractive opportunities frequently emerge in overlooked segments, such as offshore exploration in politically complex regions. These areas carry higher perceived risk, but also limited competition and lower valuation premiums. In resource investing, value often appears where enthusiasm is absent, and headlines discourage participation.
I need to say something else, Andy.
Please.
I bought, well, that's not true. I put in bids on 5 oil and gas juniors yesterday. I was underinvested in the speculative part of my oil and gas because I said to you, the big guys are so cheap, I don't need to speculate. I get a good enough move out of beta. I don't need to chase alpha.
Right.
But there's a subsector of oil and gas juniors, people that aren't in the United States and Canada. They're in countries that people hate. And they aren't in shale. They're in conventional offshore exploration. And those stocks haven't moved at all. There are some seismically supported plays that I think have wonderful risk-reward parameters, provided that you understand that they're risky. Mm-hmm. And I'm not going to give you the names because I'm not Phil yet. But let me tell you what they share in common.
Yeah.
Each one is exploring for what could be a very large discovery. And each of them are well seismically supported, and they have producing analogs in the same basin, which is to say there's good exploration science. They are well enough seismically supported that the industry would tell you that each discovery hole stands between a 25 and a 35% chance of success. Turning that the other way around, there's a there's 3 chances in 4 that you fail.
Right.
Or 2 chances in 3 that you fail. In other words, the probability is failure. Mm-hmm. Because they're public, in other words, because I'm not drilling a well with my own money, where if it dry holes, it goes to 0, the likelihood is that on an unsuccessful effort, I lose 35 to 50% of my money on any unsuccessful effort. By spreading my risks over 5 bets, the upside is if I hit, I get 15 or 20 to 1. So the gross arithmetic is I have 5 starts. I have let's be conservative and say 25% chance of success on any start, which means statistically over 5 starts, I likely have 1 success.
Right.
On my 4 fails, I lose 35% each on 4 starts. And on my hit, I get 15 to 1.
Yeah.
That's pretty good math.
The math works.
That's pretty good math. What I like about it is there's no premium. There's no success premium. These little penny dreadful silver mining stocks, somebody right now gets some surface samples, particularly if they get the surface samples in British Columbia or, Colorado in the United States. The surface sample gives them a $15 million valuation, which is to say there's an incredible premium built in for the expectation of success. In these little offshore juniors, because they're in countries that many people can't pronounce, offshore exploration is unloved. These countries are unloved, and oil and gas is mostly unloved. So there's a situation where I couldn't help myself. I had to take this exploration shot.
Okay, so I want to work a lot about that because I love the risk assessment, and it's almost gaming in the sense of just playing probabilities, right?
Right.
You're playing probabilities. But what's also, I think, key most people lose is that you're going for a big asset.
I can't emphasize this to your listeners enough. If you're taking the risk inherent in exploration, which whether you admit it to yourself or not, has the probability of failure. In other words, it's more likely that you lose money than you don't. The wins have to amortize the losers. And you can't be playing a speculative game, a real speculative game, for a double or a triple. That can be your interim goal. At a double or a triple, you take enough money off the table that you've de-risked the rest. I get that part. But you have to be playing the game for a 10-bagger. Or else, arithmetically, you're not speculating, you're losing. There are a lot of people for whom a win is psychological, which is to say they take a risk of a wipeout, they make 30% on a trade, and they go home happy. Those people are dumb because the expectation over 10 starts is that you have 6 or 7 losers. If you make 30% on 2 and you lose 25% on 8, guess what? You might feel good about the 2. But you've done yourself an enormous disservice financially. In exploration, the size of the prize, the probability of success, and the cost of the test are the questions you have to ask yourself.
True speculation is a game of probabilities, not hope. Exploration drilling, whether in mining or energy, carries a higher chance of failure than success. A single well may have only a 25 to 35% probability of striking commercial reserves. However, if successful, returns can reach 10 or even 20 times the initial investment. By spreading capital across multiple opportunities, investors rely on statistical advantage. Small wins cannot offset frequent losses. Only asymmetric outcomes can. The key variables are size of potential discovery, probability of success, and cost of the test. Without large upside potential, speculation becomes mathematically unfavorable.
Right.
Well, I would sort of agree with you. But I have to say, my worst experience with political risk was in the People's Republic of California.
Yeah, right.
I'm not trying to say that Guyana is good or Namibia is good. I'm trying to say the United States is bad too.
Yeah.
It's predictably bad, which is good. What we do have in the United States mostly is the rule of law. Some parts of the United States, like California, they aren't paying attention to the rule of law, but it exists. There's predictability, but you have to look at the other jurisdictions on a case-by-case basis. What's the fiscal regime like? Can you get a fiscal stability agreement? A lot of these countries, they're real cool with you fiscally until you make a discovery. And then when they see that there's $3 or $4 billion to steal, they change the terms after the fact. They take it.
Yeah.
But if you have a fiscal stability agreement before you drill the well, where they're bound by that agreement for 20 years and where it's arbitrated in Stockholm or Geneva, that's a better circumstance. In some cases, a much better circumstance. So you have to do it on a case-by-case basis. When I see smarter, more sophisticated players than I let's say I see Exxon in a basin, Chevron in a basin, Total in a basin, I feel better about that basin when the concession that I'm drilling, or that I'm even just shooting seismic on, has a fiscal stability agreement in place with a host government where they can't change the terms on me after discovery. I can afford to be more generous. Mm-hmm. The difficulty I have, I guess the advantage I have is I'm competing with speculators who don't know what a fiscal stability agreement is, much less are willing to take the time to figure out if there is one. So to come down to the 5 stocks that I bid on yesterday, they were narrowed down from a list of 31 stocks that I spent, I don't know, 3 or 4 months pawing through data about.
Investing beyond North America introduces jurisdictional uncertainty, but also opportunity. Some countries offer fiscal stability agreements that protect investors from sudden tax changes after a discovery. When contracts are enforceable through international arbitration centers such as Stockholm or Geneva, risk can be more predictable. Importantly, even developed regions are not immune to regulatory shifts. Evaluating political risk requires examining legal frameworks, contract stability, and the presence of major industry players. If global firms operate successfully within a basin, it often signals manageable risk. Thorough research can transform what appears dangerous into a calculated and informed decision.
Really, the seismic. The probability of success. Now, the other thing was that each one of these 5 companies has somebody who I've done successful business with in the past.
So you knew them?
Well, I knew some people in the company.
Right.
If it wasn't the CEO, it was the chairman, it was a director, it was the largest shareholder. I knew the reasons, if any, why the stocks were cheap.
Yeah.
One of them is preparing to go into a truly foul jurisdiction. And they're going into a foul jurisdiction in an asset that I used to own part of before it was nationalized. And I really like the asset. You know?
One overlooked advantage in resource investing is access to leadership. Industry gatherings, such as the annual conference in Boca Raton, bring investors face-to-face with CEOs and major shareholders. Unlike passive investing, this sector rewards direct questioning and independent research. Many successful entrepreneurs are eager to discuss their projects in depth. Preparing beforehand, studying interviews, reviewing financials, and targeting specific companies maximizes value from these interactions. In volatile markets, knowledge compounds advantage. Ultimately, success belongs to those who combine discipline, probabilistic thinking, and first-hand insight, transforming uncertainty into strategic opportunity rather than emotional reaction.
If you come there, I'm not saying you shouldn't go on the boat cruise, but if you come just to go on the boat cruise, you can go on a boat cruise anytime.
Right.
What's lovely about this conference is that you can, and not just you, but your listeners can walk up to the CEO and they will talk. If you listen to my pre-conference interviews, which you should, I interview every CEO of every exhibitor before the conference, so that listeners can utilize their time at the conference more efficiently. But at the end of every CEO interview, I ask specifically, who at the company can my attendees learn more about the company from? The right answer is when the CEO says, me. Mm-hmm. The buck stops with me. Most of my CEOs will say, here's my email address, but if you want, here's my cell phone. Mm-hmm. George Salamis at Integra says the best place to learn about Integra is by calling me. I'm the CEO. I'm the largest shareholder. Here's my cell phone number. Yeah.